Brian Hicks is claiming Trump is buying up certain stocks and they could explode as a result. I reveal the stocks here for free so you don't have to pay for them. There's lots of stocks to uncover, so we'll just jump into things. All the stocks here are resource stocks. Brian Hicks believes Trump's administration could buy a stake in, like they did with MP Materials. Here's the clues for the first stock. The only significant primary platinum source in the Western Hemisphere, controlled by a sub-$10 stock. Platinum is ripping, and this stock is up 145% this year, crushing gold, silver, even Nvidia. Hybrids, hydrogen, and heavy industry all devour platinum. So do missiles and defense electronics. Wall Street's still asleep. The stock being pitched here is Sibanye-Stillwater. Here's what to know about this stock. The headline is impossible to ignore. A 281% year-to-date surge. This isn't a small bounce. It's a full-blown comeback. The stock exploded from $3.05 to over $12.35, making it one of 2025's top performers. Sibanye-Stillwater isn't just a South African gold miner anymore. It's a global operator. With nearly 58,000 employees across 5 continents, the company has transformed itself since its 2013 launch through aggressive acquisitions and expansion. That global footprint matters. It spreads risk and gives them access to critical resources. Their portfolio is what sets them apart as the world's largest platinum group metals producer, spanning platinum, palladium, rhodium, and gold, with added exposure to lithium, nickel, chrome, and copper. That diversification hedges single commodity risk and positions the company for EVs and the energy transition, but it was stress-tested hard last year. 2024 was brutal. Platinum and palladium prices collapsed below $1,000 an ounce, forcing major impairments, production cuts, and a painful restructuring that crushed profitability. That reset, while necessary, laid the groundwork for the rebound. Now comes 2025, the turning point. PGM prices have surged, with platinum up 65% and palladium up 50% as supply deficits bite. Sibanye-Stillwater is riding a powerful commodity tailwind, and this price rebound is the main driver of the stock's massive year-to-date gain. This is how the market views the company today. It carries an $8.87 billion market cap and is trading near its 52-week high, a dramatic turnaround from the crisis lows. A forward PE of 8.28 stands out for a company in recovery, signaling that investors are pricing in renewed growth and a return to profits. But valuation is only part of the story. Scale matters too. Despite recent challenges, Sibanye-Stillwater remains a revenue heavyweight, generating roughly 111 billion South African rand annually. That top line reflects the size and diversity of its operations and shows real resilience through a severe commodity downturn. Still, revenue alone doesn't guarantee success. The key issue is profitability. Margins are currently negative at 3.18%. A lingering effect of the 2024 price collapse and restructuring. Yet the stock's rally suggests the market expects a sharp return to profits and is already discounting it. The next question is whether that rebound can be sustained, which leads directly to the company's long-term strategy. That's where the strategy comes in. Sibanye-Stillwater isn't relying solely on a PGM bounce. It's pushing into clean energy metals through its lithium project in Finland and a nickel plant in France, expanding into battery materials. This shift reduces single commodity risk and gives the company exposure to long-term EV and energy transition growth. At the same time, PGM fundamentals are tightening. Supply deficits persist, while demand remains anchored by catalytic converters and broader industrial uses. In a constrained market like this, even modest demand growth can produce outsized price moves. These dynamics form the backbone of the recovery story. The investment thesis is straightforward. This is a high-risk, high-reward recovery play with significant operating leverage. Higher PGM prices flow almost directly to the bottom line once fixed costs are covered. You're essentially buying leveraged exposure to a tightening PGM market, volatile, but with meaningful upside if the commodity cycle keeps turning higher. Every high-reward setup comes with real risk. The biggest is commodity volatility. Another drop in PGM prices would quickly undo the operating leverage driving the recovery. There's also meaningful geopolitical risk, with much of the business based in South Africa, where labor and political issues can disrupt operations. Add in the everyday realities of mining. Power outages, safety incidents, production hiccups, and volatility is simply part of the deal. Analysts, after weighing those risks, are cautiously optimistic. The consensus price target sits around $12.64, with highs near $13.70 and a market perform rating. That reflects the view that much of the initial rebound is already priced in, but upside remains if PGM prices stay strong. In short, Wall Street isn't calling it a screaming buy, but it does see the turnaround as real and sustainable at current levels. And that's how I feel. It would have been better to have bought 6 months ago, but I still think this stock is a moderate buy. Here's the clues for the second stock. North America's largest independent gold resource, 13.6 million ounces measured and indicated, backed by billionaires Eric Sprott and John Paulson. With road, grid, and pipeline access already in place, it's Alaska's sleeping giant. Gold has always underpinned national power, and now it's being positioned to anchor America's first sovereign wealth fund. And yet this stock still trades for around $1 a share. The stock being pitched here is Tower Hill Mines. Here's what to know about it. The numbers tell the story. A staggering 293% year-to-date return. The stock surged from 43 cents to over $3 at its peak, massively outperforming the broader market. This isn't a gradual climb. It's a sharp, momentum-driven run that signals a major shift in investor sentiment. At the center of the story is the Good Gold Project in Alaska. The project hosts an estimated 13.6 million ounces of measured and indicated gold resources, making it one of the largest gold discoveries globally in the past 20 years. With a projected mine life exceeding 23 years and access to established infrastructure in a stable U.S. jurisdiction, Good stands out as a true Tier 1 gold asset. The original feasibility study assumed a gold price of $1,650 per ounce. Today, gold trades above $4,000, creating roughly a 2.4 times uplift in the potential value of each ounce produced. With some forecasts pointing toward $5,000 gold, the economic leverage to higher prices is substantial. Beyond gold, the discovery of antimony adds a strategic second dimension. Antimony is a critical mineral used in defense applications such as armor and night vision systems. After China cut global supply by roughly 97%, the U.S. government allocated over $1 billion to secure domestic sources. This positions the project as a potential supplier, opening the door to a high-value strategic revenue stream. Even after the sharp rally, the company's market capitalization remains a fraction of the project's potential net present value if production moves forward. As a pre-revenue development stage asset, the valuation reflects execution risk, not just upside. That disconnect creates a wide valuation gap. High risk, but with outsized reward potential if milestones are achieved. The key remaining hurdle is financing. Building the mine requires approximately $1.93 billion, making this the defining catalyst for the project. With the pre-feasibility study completed and ongoing work focused on the antimony potential, securing a full financing package is the most critical step toward production. The upside case is driven by multiple converging factors: record high gold prices, the strategic value of antimony as a critical mineral, a long-life asset in a stable Alaska jurisdiction, and strong market momentum. Together, these elements create a compelling risk-reward setup. The risks are significant. Financing nearly $2 billion is a major challenge, especially for a pre-revenue company with ongoing cash burn. Potential equity raises could dilute existing shareholders, and as with any large-scale mining project, execution and operational risks remain ever-present. Pre-revenue mines are always very risky because most don't work out, but there's monster gain potential here if it does. Plus, it has the backing of well-known gold investors like Sprott and Paulson. If you have the appetite for risk and a load of patience, this one could be interesting. Here's the clues for the third stock: Oregon's colossal lithium deposit that could be 10 times bigger than Bolivia's. It's enough to power 600 million Teslas. Huge land package controlled by sub-$1 stock already working with state and federal officials to develop it. Forecast: 1.8 million tons of battery-grade lithium carbonate over 40 years. This could be America's most important lithium asset. Batteries for defense, EVs, and AI data centers all run on it. This stock is Jindalee Lithium. Here's what to know about this stock. The global electric vehicle transition is accelerating, with EV sales surpassing 20 million units and lithium demand expected to climb another 30% by 2026. After a sharp market correction, lithium prices are rebounding as the U.S. intensifies efforts to secure domestic supply and reduce dependence on foreign producers. Jindalee's stock has gained roughly 149% over the past year, reflecting growing investor interest. Despite the run, it remains a small-cap company with a market value of around $51 million. Its relatively low beta suggests less volatility than the broader market, pointing to early but measured confidence in the underlying story. The McDermott project sits on the Oregon-Nevada border and stands out for its sheer scale. Estimated resources total roughly 21.5 million tons of lithium carbonate equivalent, with some estimates as high as 40 million tons. At current lithium prices, the in-ground value is often cited in the trillions of dollars. Jindalee holds 100% ownership of this asset. The pre-feasibility study outlines a 63-year mine life, positioning McDermott as a long-duration strategic lithium supply rather than a short-cycle project. With a projected payback period of around 5 years, the mine is designed to support decades of battery-grade lithium production for the U.S. market. McDermott has received Fast 41 designation, enabling an expedited federal permitting process. This status highlights the project's strategic importance as the United States accelerates efforts to secure domestic sources of critical minerals and reduce reliance on foreign supply chains. The 2025 drilling program has been completed, with the project now moving through the permitting process and preparing for a full feasibility study. At the same time, discussions are underway with strategic partners and U.S. government entities around potential funding and co-investment, signaling continued forward progress. Jindalee remains an early-stage, pre-revenue exploration company. It is currently operating at a loss and will require substantial capital to advance a project of this scale. Key risks include permitting timelines, volatility in lithium prices, and the execution challenges involved in developing a multi-decade operation. The opportunity is defined by extremes. On the upside, this is a world-class lithium asset with massive scale, supportive government initiatives, and growing attention from the market. On the downside, it is a small-cap, capital-intensive project with meaningful execution and financing risk, making it a classic high-risk, high-reward investment. This is another stock that's insanely risky but has a huge ceiling. However, this one is probably going to require even more patience than the last two stocks. You buy now hoping for a payoff in 5 to 10 years. It could happen, but there's a lot of landmines here. Here's the clues for the fourth stock: the only direct lithium extraction project on Trump's Fast 41 shortlist. The stock behind this next-generation lithium extraction plant is backed by the Department of Energy and critical to America's EV supply chain. Yet it still trades under $3, and with permit approvals collapsing to 28 days, its re-rating could be explosive. In an age where AI command centers and missile systems depend on battery storage, this project is indispensable. This stock is Standard Lithium. Here's what to know about this stock. Standard Lithium is positioning itself as a leader in next-generation lithium extraction in the United States. With a market capitalization exceeding $1 billion, the company is focused on advancing new technology that could reshape how lithium is produced domestically. The stock has delivered outsized gains, rising roughly 212% year-to-date and about 173% over the past year. Shares have climbed from just over $1 to nearly $5, reflecting strong momentum and growing market recognition of the opportunity. The core driver is direct lithium extraction, a cleaner and more efficient alternative to traditional open-pit mining. DLE enables the extraction of high-purity lithium directly from underground brine with a smaller environmental footprint. Through its partnership with Koch Industries and a proprietary DLE process, Standard Lithium has developed a potential technological advantage within the sector. Standard Lithium is applying its DLE technology to one of the largest undeveloped lithium resources in North America, the Smackover Formation. Spanning from Florida to Texas, this geological formation is estimated to contain over 5 million tons of lithium. The company controls roughly 30,000 acres in Arkansas and is advancing a separate East Texas project that features some of the highest-grade lithium brine in the region. U.S. government backing is a major pillar of the story. Standard Lithium has secured a $225 million grant from the Department of Energy, received fast-track permitting support at the federal level, and is being considered under the Defense Production Act due to the project's strategic importance. Policymakers have publicly pointed to the company as a leading domestic DLE operator, underscoring its role in strengthening U.S. energy and supply chain security. The company is supported by a deep bench of strategic partners. Koch Industries is both a technology partner and the largest shareholder. Global energy major Equinor has co-invested in the company's $1.45 billion flagship project, alongside backing from international credit agencies in Norway, Korea, and Japan. Notably, the company maintains a debt-free balance sheet while preparing to scale. The project roadmap targets construction beginning in 2026, with first production expected in 2028. Initial output is projected at 22,500 tons of battery-grade lithium carbonate per year. Estimated production costs are under $6,000 per ton, versus a target selling price around $22,000, implying exceptionally strong potential margins. Global EV adoption continues to accelerate, with more than 20 million electric vehicles expected to be sold in 2025 alone. This surge is driving lithium demand, with forecasts calling for 30 to 40% growth in 2026. After a recent pullback, lithium prices are rebounding, and some analysts project prices as high as $28,000 per ton. Analyst sentiment has turned decisively positive. Current coverage includes multiple strong buy ratings with no sell calls. Consensus price targets imply roughly 15% upside, with bullish estimates pointing to gains of up to 60%. Institutional confidence has recovered following bearish narratives that weighed on the stock in 2022. Standard Lithium represents a high-risk, high-reward bet on the future of U.S.-based energy and battery supply chains. The story combines advanced extraction technology, large domestic resources, strong government and institutional support, and favorable market timing. While the company remains pre-revenue and execution risk is real, the upside case remains highly compelling. I like Standard Lithium and have heard about this stock for years. The stock price is starting to price in future results, but I still think it's a buy. Here's the clues for the last stock. 4 billion pounds of copper and 500 million ounces of silver in Montana. Copper is the choke point for AI computers and the defense grid. Silver just hit a 14-year high, and every solar panel, smartphone, missile system, and electronic device on Earth relies on it. You can't recycle enough to meet demand, new supply must be mined. This sub-$9 stock gives you both. This stock is Hecla Mining. Here's what to know about this stock. Hecla Mining is one of the most established names in precious metals, with more than a century of operating history in the United States. As a long-standing domestic producer, the company stands out as a major player in the silver space. Hecla is the largest silver producer in the United States and Canada, accounting for roughly 37% of U.S. silver output. On a global scale, it ranks as the third largest silver producer, delivering about 16.2 million ounces of silver in 2024 alone. This operational dominance has translated into strong market performance. Over the past year, Hecla's stock has climbed more than 200%, including a 51% gain in the last quarter and a 26% move in just the past week, reflecting powerful investor momentum. How do they do it? With a portfolio of 4 strategically located high-performing mines across North America, from the flagship Greens Creek mine in Alaska to the massive silver reserves of Keno Hill in the Yukon, Hecla's operations are a masterclass in efficiency and scale. The results speak for themselves. Hecla just posted a record-shattering third quarter, with revenues topping $409 million and a staggering all-time high EBITDA of nearly $196 million. Every single one of their mines is generating positive free cash flow. This is a company firing on all cylinders. But here's the truly mind-blowing part. Hecla's economics are unbeatable. Thanks to valuable byproducts, Their cash cost to produce silver is negative. That's right. They are essentially paid to mine it. With silver prices over $42, their profit margin is a massive $31 per ounce. It's a pure profit machine. Hecla holds approximately 240 million ounces of silver reserves, the second highest level in its 130-year history. In addition, the company controls around 2.7 million ounces of gold, providing a deep base of long-life tangible assets. The silver market is entering a period of structural tightness, with a supply deficit extending into a fifth straight year, while industrial and investment demand continue to rise. Against this backdrop, analysts have projected silver prices near $40 and gold prices potentially approaching $5,000, creating a supportive macro environment. Several near-term catalysts are in play. Hecla is set to join the S&P Midcap 400 index, increasing institutional visibility. The Keno Hill mine is ramping toward full production, while expanded exploration efforts and a significantly reduced debt profile position the company for continued growth. This is another stock that prices in future success but is still a buy. Before you go, don't forget to grab my free report. The 10 stocks I believe you can buy today and hold forever. It's packed with solid long-term picks you won't hear hyped up anywhere else. Just click the link in the description, enter your email, and I'll send it straight to you.